There are exactly 4 ways to invest money in the stock market. But here's what most people miss. Only one of them lets your money keep working automatically, while the others, they need constant attention or they fall behind. Here's which one and why it actually matters to your wallet. And to keep this simple, we're going to explain the entire system using one analogy you already understand: pizza. Let's say you have $10,000 to invest. You walk into the market and immediately hit a wall. There are literally thousands of options. So to make it manageable, the investment industry created 4 containers to put that money into. Each one works differently. Each one costs you different amounts of money. And this is the critical part: each one delivers different results over time. Most people pick based on a feeling or what they heard at a dinner party, but they're missing the actual system underneath. That's where the real money difference lives. Here's the foundation. In 1973, a finance professor named Burton Malkiel published a book called A Random Walk Down Wall Street. In it, he analyzed decades of data on professional fund managers. His conclusion? 80% of them failed to beat the market over 15-year periods. Not because they weren't smart, but because the market itself is so efficient that beating it consistently is nearly impossible. And even when you do, your fees eat the gains. This one finding changed investing forever. It proved that the traditional model, paying a professional to pick stocks for you, was mathematically doomed for most people. 5 years later, in 1976, Vanguard founder John Bogle took Malkiel's research seriously and created the first index fund available to regular people, the Vanguard 500. The idea was radical. Instead of hiring expensive managers, just buy all 500 companies in the S&P 500 in the exact same proportions. Hold them, do nothing. Let the market itself be your strategy. Nobody had ever tried this at scale before. Wall Street said it would fail. It didn't. Let me explain how an index fund actually works. You pick an index. The S&P 500 is the most popular, which represents the 500 largest companies in America. The fund manager then buys shares in all 500 companies, weighted exactly as they appear in the index. If Apple is 7% of the S&P 500, then Apple is 7% of your fund. If Coca-Cola is 0.5%, then it's 0.5% of your fund. The manager rebalances occasionally to keep these weights accurate, but that's it. No stock picking. No, this looks overvalued. Let me sell it. No, my gut says this company will crush it. Just mechanical adherence to the list. Because the manager isn't making active decisions, they're running what's essentially a robot. They can charge almost nothing. Most index funds charge between 0.03% and 0.20% per year. This is called the expense ratio. On a $10,000 investment, you're paying $3 to $20 per year. Over a lifetime, this difference is staggering. Now, the mutual fund is the opposite model. A mutual fund has a real person, a portfolio manager with a Harvard MBA, 20 years of experience, teams of analysts. That manager is sitting in an office every single day, analyzing financial statements, reading earnings reports, making bets on which companies will outperform. I think this tech stock is undervalued. I think this retailer is overvalued. I'm going to buy the winners and avoid the losers. It sounds brilliant. It sounds like you're paying for expertise. Here's the catch. It works sometimes. Maybe your manager crushes it for 3 years, beating the market by 3% annually. Then the market shifts. The economy slows, tech stocks fall, bond yields rise, and suddenly the manager's whole thesis is wrong. They're picking losers. But you know what never changes? The fee. Because the manager is actively managing the fund, doing research, making trades, they charge 0.5% to 2% per year. On that same $10,000, you're paying $50 to $200 per year. That's 50 times more expensive than an index fund. Here's the brutal math. Even if your manager beats the market by 2% per year, which is rare, but charges you 1.5% in fees, you're not ahead. You're actually behind. The fee ate the outperformance. And this isn't theoretical. From 1990 to 2020, 82% of actively managed mutual funds underperformed the S&P 500. A $100 investment in an S&P 500 index fund in 1990 would be worth $6,727 by 2020. That same $100 in the average actively managed mutual fund? $4,600. The fees alone cost you over $2,000 in gains. Then came the ETF, the exchange-traded fund. This is where the story gets interesting. An ETF is mechanically similar to an index fund. It tracks an index. It charges low fees. But there's one critical difference. An ETF trades like a stock. An index fund can only be bought or sold once per day at the closing price. An ETF can be traded every second the market is open. The price updates minute by minute based on supply and demand. For most retail investors, this doesn't matter, but for traders or people who want flexibility, it's useful. The other advantage? ETFs often have slightly lower fees than index funds. You can find ETFs charging 0.03% to 0.15% per year, sometimes even cheaper, so you get the passive investing advantage plus trading flexibility. Finally, hedge funds. This is the exotic category. A hedge fund is a pooled investment fund run by someone with a specialized strategy. Maybe they buy stocks and also short sell them, betting against companies they think will fail. Maybe they trade derivatives or futures. Maybe they use leverage, borrowed money, to amplify returns. The pitch is always the same. We have an edge. We can make money in any market condition. Bull markets, bear markets, sideways markets, we're that good. And for this supposed brilliance, you pay 2% of your assets per year, plus 20% of any profits. That's called the 2 and 20 fee structure. On a $100,000 investment, that's $2,000 per year just to have your money managed, plus they take a fifth of your gains. On a $10,000 investment, you're looking at $200 per year minimum before any profits are made. And these funds don't accept regular people anyway. You typically need a minimum of $100,000 to $1 million just to get in the door. They're designed for wealthy institutions and ultra-high net worth individuals. Okay, here's where the pizza analogy ties everything together. Imagine your money is a single pizza. You have one slice to invest. An index fund is like saying, give me a slice from every restaurant in the city proportional to how the city rates them. You get every restaurant's pizza. No chef is trying to trick you. The owner charges you 30 cents for your slice and you go home with amazing food. A mutual fund is like hiring a pizza expert who charges you $5 and promises they'll pick the one perfect pizza, the best slice in the entire city. Sometimes they're right. Most times you would have been better off just getting one from every restaurant. The experts oversell their ability. An ETF is the same as the index fund pizza deal. You get one from every restaurant at 30 cents. But you can trade your pizza every 30 seconds if you want. Useful if you're a pizza trader. And a hedge fund? That's a celebrity chef who charges you $200 up front, uses secret exotic ingredients, leverages multiple ovens, and then keeps 20% of your leftovers if the pizza turns out amazing. But if it doesn't, you still pay the $200. The data is unambiguous. From 2000 to 2020, the average stock market return, captured perfectly by an index fund, was about 9.5% per year. The average actively managed mutual fund returned 7.1% per year. That 2.4% annual difference compounds into something massive. A $50,000 investment at 9.5% per year becomes $539,000 over 25 years. At 7.1% per year, it becomes $339,000. The same $50,000 invested in an index fund versus an active fund leaves you $200,000 ahead. That's the fee difference over time. Let's bust the myths that everyone believes. Myth number 1. Professional managers can beat the market because they have access to better information. False. The market is efficient. Millions of sophisticated traders worldwide process information in milliseconds. A manager sitting in an office can't consistently outsmart that. Myth number 2. You need an actively managed fund to stay ahead of inflation. Wrong. An index fund beats inflation by the exact historical average, about 9.5% per year. That outpaces inflation by 5 to 6 percentage points on average. Myth number 3. Hedge funds are safer because they use sophisticated strategies. Not necessarily. Hedge funds are more complex, which means more things can go wrong. They're not inherently safer, they're just different, and they're expensive. So here's what to do with this. If you're just starting out or you have less than $1 million, index funds or low-cost ETFs aren't a compromise. They're the mathematically smarter choice, full stop. You get the market return, the actual reality of the economy, without paying someone to fail to beat it. Pick one broad market index fund or ETF, Vanguard Total Stock Market, Fidelity Total Market, or SPLG, the S&P 500 ETF. Or if you want international diversification, mix in a total international stock fund. Invest regularly, even $100 a month compounds. Don't check it every day. Don't panic sell when the market drops 10%. Come back in 20 years, that's the system that actually works. The other 3 fund types, they have their place. Professional traders at hedge funds use sophisticated strategies that require expertise. Active mutual fund managers still exist and serve specific roles. But for you, someone building wealth from scratch, they're not better. They're just more expensive. If this clicked for you, the one action to take right now is open your brokerage account and look at your current funds. Check the expense ratio. If it's above 0.5%, you're leaking money every year. Find the low-cost index fund or ETF alternative. Swap to it today. The difference over 30 years? Hundreds of thousands of dollars. Drop a comment if you've got questions about fund types. I read everyone. If you want more of this stuff, hit subscribe. Next week, we're tackling something that breaks most people's financial plans: why your salary is lying to you. It's called inflation, and we're explaining exactly how it erodes your money. And thanks for watching. See you next week.